Cognitive biases in investing. It's like having a blindfold on while trying to navigate a minefield. Today on Unlocking the Upside, we're diving into how these mental shortcuts can cost investors billions and what we can do to outsmart our own brains. Hi, I'm Jeff Robinson from theinvestmentanalyst.com, and I'm joined today by my partner in crime, James.
Hi everyone, and wow, that's quite an image. Are these biases really that impactful on our financial decisions?
Absolutely. These biases can lead to massive market swings and individual financial disasters. Take the COVID-19 market crash in March 2020, for example. Recency bias caused many investors to panic sell at the bottom, locking in huge losses and missing out on the subsequent recovery. It's estimated that poor investment timing driven by behavioral biases can cost the average investor 1 to 2% in annual returns.
That's a significant hit to someone's portfolio over time. What are some of the most common biases we should be aware of?
Well, there are quite a few, but let's focus on some heavy hitters. Overconfidence bias is a big one. It's when investors overestimate their ability to predict market movements. This often leads to excessive trading and taking on more risk than is prudent. Then there's anchoring, where investors fixate on a specific piece of information, like an asset's initial price, even when it's no longer relevant.
I can see how those could be problematic. Are there any emotional biases that come into play as well?
Oh, absolutely. Emotions play a huge role in investing. Loss aversion is a prime example. The pain of losing money feels about twice as intense as the pleasure of gaining an equivalent amount. This can lead investors to hold on to losing investments for too long, hoping they'll bounce back while selling winners too quickly. Another big one is herd behavior, where investors follow the crowd without doing their own analysis.
That reminds me of the dot-com bubble in the late 90s. Everyone was jumping on the tech stock bandwagon, and we know how that turned out. Are there any strategies investors can use to counteract these biases?
Definitely. One key approach is enhancing self-awareness. By reflecting on past decisions and outcomes, investors can start to recognize patterns in their thinking that might be influenced by biases. Implementing structured decision-making frameworks is another effective strategy. These can help investors evaluate opportunities more systematically, reducing the influence of emotions and cognitive shortcuts.
So like having a checklist of criteria to consider before making an investment decision?
Exactly. In fact, using checklists is another recommended strategy, similar to those used in fields like medicine and aviation. It helps ensure all relevant factors are considered before making a decision. Diversification is also crucial. By spreading investments across various asset classes, investors can reduce the impact of any single bias on their overall portfolio performance.
I've always heard that diversification is important, but I never thought about it in terms of mitigating biases. That's an interesting perspective. Are there any technological tools that can help with this?
Yes, actually. Robo advisors and algorithmic trading platforms have become increasingly popular tools for mitigating behavioral biases. These platforms use data-driven approaches to make investment decisions, removing much of the emotional component from the process. However, it's important to note that while these tools can be helpful, they're not infallible. The algorithms themselves can potentially incorporate biases, so it's crucial to understand how they work and to use them as part of a broader, well-thought-out investment strategy.
Interesting. It sounds like there's no silver bullet for overcoming these biases. What would you say is the most important thing for investors to keep in mind?
Well, I think the most crucial thing is to cultivate self-awareness and a willingness to learn. Recognizing that we're all susceptible to these biases is the first step. From there, it's about developing a disciplined approach to investing that incorporates strategies to mitigate these biases. This might involve setting clear investment goals, regularly reviewing and rebalancing your portfolio, seeking diverse perspectives, and staying educated about market dynamics and your own psychological tendencies.
That's excellent advice. It seems like a lifelong journey of self-improvement and learning. Do you have any final thoughts or recommendations for our listeners?
Absolutely. I'd encourage everyone to take some time to reflect on their own investment decisions. Try to identify any patterns or tendencies that might be influenced by these biases we've discussed. Consider keeping an investment journal where you record not just your decisions, but also your reasoning and emotional state at the time. This can be an invaluable tool for recognizing your own biases over time.
That's a great idea. It's like creating your own personal case study.
Exactly. And remember, it's okay to seek professional guidance. Financial advisors can provide valuable, objective insights to help navigate these complex issues. They can also act as a sounding board and help you stick to your long-term investment strategy when emotions are running high.
Thank you for this fascinating discussion on cognitive biases in investing. I'm sure our listeners will find it as enlightening as I have.
It's been my pleasure. As we wrap up, I want to emphasize that while these biases can be challenging to overcome, being aware of them is a powerful first step. By implementing the strategies we've discussed and remaining committed to ongoing education and self-reflection, investors can significantly improve their decision-making processes and ultimately their financial outcomes. Until next time, this is Unlocking the Upside, reminding you to invest wisely and stay aware of those sneaky biases.